Today, we're going to look into breakout trading. And if you ever want to ride those waves in price that you see, this is going to be a great video for you. Now, breakouts have always been pretty popular because they can lead to pretty significant profits when you get them right. So, what is a breakout? That just occurs when the price of an asset, doesn't matter what it is, moves beyond a defined support or resistance level. And that signals potential momentum in that direction. I say potential because it could fail. Now, the psychology behind it, it's pretty impressive. Traders will often pile in when they see prices breaking out. So it's almost like a self-fulfilling prophecy at times. But just remember, for a breakout to be sustainable, you're going to need more than a retail trader heading in that breakout direction. So let's just talk about some key breakout patterns. And the most common ones, and the only ones you really need to worry about, triangles, flags, and channels. Triangles. These just form when prices converge. That indicates a potential breakout either upward or downward depending on the triangle. Flags, these are just short-term consolidation patterns, often form after a strong move in price in either direction. And that signals continuation. That first leg is the important one, that initial move. And channels, these just occur between two parallel trend lines, and a breakout signals a strong directional move. And to identify them, just look for the price action that looks like one of these patterns. And the tighter the pattern, the stronger the potential breakout. So a tight trading pattern, it reflects a consolidation phase where we see a balance of supply and demand that leads to market indecision and also indicates accumulating potential energy for a move. So that period of equilibrium, this can actually hide underlying accumulation or distribution. It sets the stage for a sharp breakout when prices finally break that established range. So when we talk about breakouts, let's talk about time frames. Now, choosing the right time frame is important. In breakout trading, you can use intraday strategies on a 5-minute or an hourly chart. You can look for longer term trades on dailies or weeklies, and each of them are going to have their own pros and cons. So a 60-minute, a high-low breakout, for example, it's popular because it balances quicker action with enough time for a trend to develop, right? So you want to tailor whatever strategy you use to your preferred style and, of course, your risk tolerance. But here's a question for you. Are breakout patterns on a higher time frame more important? Well, the answer is no. Time frames, they pass control at any moment and can become the dominant force. So let's say we have an uptrend on a daily chart. Well, we're going to see that breaking down first on a 5-minute, a 2-minute, a 1-minute chart, right? So that breakdown on that 5-minute chart can lead to a complete reversal on the daily chart. So you never know when that's going to happen. So how do we get into these? Well, the established routine is enter your trade once the price closes above resistance or below support. That's a confirmation of the breakout. But is there another way? Absolutely. Enter inside the consolidation before the break. So when you get price basing tight under a resistance zone, for example, and it's not breaking down, this is a sign that the breakout has a higher chance of succeeding. So if you enter long under that resistance level, either through a candlestick pattern like a spring or momentum candles, or you see a momentum indicator shift, well, that gets you in early. And who's also in early? The bigger money. So is volume important on the break? Obviously, you're going to want to see some greater activity, but the more important area for a higher volume is after the breakout. You want to see continued positive activity and not a drying up of volume. You may get a little bit as price might consolidate depending on the breakout, but you don't want to see it go flat. Your stop is pretty obvious under the smaller consolidation. And when it comes to taking profits, just consider scaling out of your position as the trade goes in your favor. This way, you're going to lock in your gains, but you're still allowing for potential upside. And that also includes just peeling off some of your trade, like an 80-20 rule. Can we use indicators? Sure. Look at the relative strength index, the volume analysis, moving averages. These can help validate your trades. Now, although these are lagging, except for volume, it does give you a mechanical way to trade a breakout. So you can use an EMA, an exponential moving average, to identify the trend strength. If it's curving up, then it's still pretty strong. If the price breaks out and the EMA supports this movement, directionally, you may have a higher chance of success. And before you start heading into live trading, you got to backtest this. You can use platforms like TradingView. There's a whole bunch of MetaTrader, it doesn't matter. Test out your strategies against historical data. And just remember, you want to optimize your approach based on historical performance, but just know that going forward, it doesn't mean it's going to work. Let's look at something that's really important here. False breakouts, well, they can be pretty sneaky, but let's be honest. If price breaks above a level, well, it did break out, nothing fake about it. It just failed if it doesn't continue. Now, people also think a pullback after a breakout, especially if it dips into the previous consolidation area, is a bad thing. Well, let's look at it this way. Traders, and I include institutions when I say that, where are they accumulating? Not on the breakout. They are accumulating inside the range. That's where the bigger players work. So once that breakout happens, they are in profit. And profit taking after a quick pop in price is normal. We all do it. So this is why looking to enter prior to the breakout, it's an edge. And that edge can have a positive effect on your bottom line. Proper position sizing, this is key, right? You never want to bet the farm on one trade, right? You want to be cautious of overtrading as well. Not every potential breakout is worth your time. Stick to your strategy, be patient, and we're going to talk about something that's really important. You got to practice these techniques and you have to backtest them before risking your money. And your homework always to go through hundreds of charts every single week. Look for breakouts that have succeeded. Look for breakouts that have succeeded and continued into a new trend leg. And also look for those that fail. And ask yourself, what do they all have in common? The ones that work, the ones that don't. That is always your homework as a trader. So listen, if you found this video helpful, give it a thumbs up, subscribe for more trading insights, and even share your own breakout experience in the comments section here. Good luck trading, and we'll see you in the next one.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.